Welcome back. You're watching Your World at 10. Another rough day for the markets, as I've just told you in the first half of the show. And today's worries come squarely from Asia and Europe. Chinese manufacturing data indicates a slowdown there. And in Europe, the ECB has warned of new bank write-downs. Well, to talk about the big picture in China and Europe and how that's likely to affect markets around the world, we're joined by Jim O'Neill. He's the head of global economic research at Goldman Sachs. Jim, great to have you on the show for the nth time in the last 3 months. What do you make of the problem coming out of Europe? And today we have a fresh situation in China, and that is one of very imminent slowing down. Do you buy into that?
I think China is showing signs of slowing down, but it's probably a good thing. According to the numbers that we follow, we have our own proprietary indicator. China's GDP growth in the past few months has probably been more than 14%. So China's growing too strongly, and whilst I can understand it might worry some people, particularly at a time where markets are so nervous anyhow, evidence of China slowing, the quicker the better, really. China needs to get down to growth somewhere between 8 and 12%, so we can stop worrying about Chinese inflation and the Chinese authorities won't have to tighten anymore. But I think that's a lot more important than the European stuff. If I look at the talk around Europe this morning, it's not quite clear to me what the new factor is in Europe. Spain was downgraded late Friday, but you know, as one of the ECB members, Noye, said over the weekend, the rating agencies aren't exactly quick out of the drawer. So I don't think there's any real new news in Europe this morning.
Jim, I'm trying to sort of rewind back to 2008 when we were going through what we now refer to as the Great Recession. I'm not sure if at that point in time anyone had quite clearly envisaged such a looming big problem of sovereign debt. Are we making this out to be a lot bigger than it is? Because you seem to suggest in your note, and if I may quote a line of your note from Thursday, whilst you talk about the euro area mess, you say it still seems to be there is so much emotional, subjective nonsense flying around. So you're saying we're making more of the Europe situation than we ought to?
Well, I think what it reveals is an ongoing pattern ever since the turmoil of late 2008. Every time there's a bit of a problem somewhere in the world, whether it from a big place or a small place, people worry that it's going to be the start of the next global collapse. We had a mild version of it in Dubai last November, if you remember, for a week or so. Rather oddly, people seem to be worried that Dubai could bring the world down, and that's what we're going through on this European situation. And as I've maintained for a while, it's pretty obvious that Greece would have problems, but you know, Greece is not a big issue unless it does cause contagion throughout every European country, particularly Italy and France. And I think people are worrying because you know it's become fashionable to worry and be scared about everything, which of course, if I'm right, gives plenty of other people an opportunity.
So how do you rate the chances of that contagion becoming a reality? Because the markets clearly are very, very skittish about everything that's going on in Europe right now. And the kind of volatility we've seen in the last 2 or 3 months is almost a hark back to 2009, 2008.
Yeah, I know, it's a bit annoying, isn't it? Some of us would like to have a slightly more calmer, peaceful lives. It feels like a never-ending saga. You know, I think probably the key thing here is some countries need to be more clear and public. I think the thing that is reminiscent of 2008 is that we don't really know who owns exposure to what. So I think one of the ways that the European policymakers could try to calm this down would be to encourage the Spanish to come up with their own version of some kind of stress test. So they can tell us what it would be in the event of the absolute worst happening to Spanish house prices, and how much that would cost the Spanish banking sector to recapitalise, and how much it cost the government. And I think if we did that, then people might calm down, because people are understandably worried that you know, Greece turned out to be a disaster, and they read all these stories about forced mergers between Caja in Spain, and you know, people are understandably worried. But I think, as I say, people worry because that's become the thing to do, and it's not obvious to me that this is, from a global perspective, so important.
So how long is this worrying period going to last? Because if China is facing runaway growth, the markets are worried. If China slows down a little bit, as was indicated today in the numbers, then the markets are worried. You've got every single change in Europe sort of setting the markets off, and then the UK and the US continue to be an overhang on the markets, and the emerging markets are always, more cause for volatility. So where does this worrying period end? When do we come back to some period of stability?
I guess we have to look to you guys in India for a bit of sensible leadership here. Seems that you guys have managed to come out with some very good GDP numbers over the weekend, and I think the thing is people need to understand from a global perspective where the world's being driven. And it's not coming out of Europe, it's coming out of the US and the BRIC countries led by China, with increasing importance of the likes of India, Brazil and Russia. In order to calm the immediate storm down, I think the fact there's a G20 meeting coming up is going to be interesting, and I think it's important that these guys say something about working together and that it's not just a European problem, it's part of the global dynamics, and that they all support EMU and they're all behind what the Europeans are trying to do. And maybe some friendly comments from them about coordinated international reform, rather than this sort of gunshot approach coming out of each Western country, which actually I suspect that's the real source of what's unnerving markets, not specifically the Greek problem. I think it's that. So I think that the G20 played a huge role in the spring of 2009, putting a floor under global markets and the recovery, and here's a chance to demonstrate that they haven't gone to sleep.
So outside of more coordinated action, Jim, what would you like to see governments, regulators across the world really work on to be able to sort of calm the nerves of this market and, allow for the rest of us to get back to business as usual?
I'd like to see I would like to see something out of the G20 showing a coherent collective stance that, again, linking it back to what I said earlier. If you go back to late 2008 and early 2009, the two clear things that allowed one to be constructive for the world was the huge fiscal and monetary stimulus in China and a highly coordinated and collective approach by all the G20 participants. What we've seen this year, primarily in the Western countries, is their own approach, which appears to be driven by domestic politics rather than any underlying economic issues. And that is what is really unnerving investors. So to stop investors being so nervous, they need to stop doing that and concentrate on ensuring what ironically is being increasing signs of recovery become lasting and helping to bring unemployment down and that we have a full-blown normal economic recovery from this mess. But if they carry on with what they've been doing in the past few weeks, then it's going to be a lot more complicated and more fragile.
Jim, let me turn your focus back to China and the US. You did mention in that Thursday note that the China-US economic outlook is simply way more important than all this European stuff. You've given me a brief comment on the fact that you're glad that China seems to be slowing down a little bit. What do you make of where the US is in its recovery cycle and what we can expect over the course of the next 6 months to a year from both these major economies?
I think the US unemployment figures are going to be very interesting on Friday. Because there's some signs, if you look at private company job intentions as well as many other usually reliable indicators, that the US employment situation may be turning. And if that's true, I think we can develop more confidence that if it weren't for the unstable markets, the US would be entering a period of 3% type recovery for a number of quarters. And if you put that in the context of what I said earlier, over the past decade, about 60% of the growth the world has had has come just from the US and China, and with many other countries benefiting indirectly from that growth in those two places. And so I think what's going on in those two countries is absolutely key. Bringing back the European angle into it, most European countries don't generate domestic demand anyhow. They're primarily exporters. And so in order to get a big slowdown in Europe, it's going to depend on their exports weakening to places like China and the US. So I think what we see in the next week or so coming out of the US and the usual monthly Chinese data is going to be very important.
I know you've eaten your hat quite literally once already this weekend, but I'm going to ask you to give me some sense of what to make of the currency markets, what we've seen on the euro, the slight bit of recovery this past week, the dollar, and of course the yuan.
You know, I think I give up talking about the Chinese currency. I was convinced, absolutely convinced, that the Chinese had let it move in May, hence why I had to eat my hat quite literally over the weekend. I was given a very interesting bread-shaped and bread-flavoured hat at a conference, and I did indeed eat it. So I think that means I'm not allowed to talk about it anymore. But that being said, it seems to me the decision to let the renminbi move at some stage has been taken, and it's just simply the Chinese choosing a moment to implement it. On the euro, I was pretty sure we'd put in a bottom the week before last. This morning in Europe, we've actually got very close to breaking below that briefly, but we're at a very interesting level. I think that while the markets are so heavily focused on this problem, it seems to be relatively easy for the dollar to stay strong. But as I remind many clients and the various commentators that call me, 6 months ago we were supposed to believe that the US dollar's reserve currency status was under threat. And markets have a very short memory, and I'm not sure that the euro will be as weak for as long as people seem to be now popularly talking about. I would guess in a few months' time from now, the euro will be closer to 130 than 120.
Jim, finally, as the global equity markets go through all this turbulence, I understand you've taken quite a fancy to a football team. I hear you were leading a $1 billion bid for Man U. Is that correct?
I am not talking about that on the record. We put a statement out a few weeks ago, and there'll be another one coming shortly.
So you won't tell me whether you're still in the race for it or not?
Watch what we say later this week.
Jim O'Neill, thank you very much. All the best with the Man U bid, and we hope to speak with you very soon again. It was so cheerful to have you on the show. Thank you very much for joining us.
Thank you. My pleasure.